Hello and welcome to CrypTalk. I'm Ross Sinclair for BizNews.com. I'm joined once again by Jaltech's own Gaurav Nair. Jaltech is an alternative investment fund manager, and if you'd like to learn more, click on the link in the description below. Just a reminder that none of this content should be taken as financial advice, and please speak to your financial advisor. Thank you for being here, Gaurav.
Thanks for having me, Ross.
So when talking about cryptocurrencies, the term mining often comes up. What is mining?
Blockchains, they're just a way to validate transactions. And compared to other ways of validating transactions, they're actually quite slow. But what's nice about them is that no one needs permission to join the network, and there's very little trust involved. And the way that this is achieved is through mining. And the basic premise behind this whole thing is that all the miners on the network, they try to validate transactions. And in order to validate the transactions, they basically say that they've checked all the transactions that are going through are indeed valid. So if you're sending me Bitcoin, that you have that Bitcoin to send to me. And there needs to be something at stake. The other miners all check the individual miner that's saying these transactions are valid. And if that miner cheats, there needs to be something at stake that they lose. On the other hand, if they're honest, then they need to gain a reward for performing this work. And so the way that the Bitcoin blockchain, for example, achieves that is that it sets very hard maths problems. The miners, they then try and solve the problem. In order to do this, they need very expensive hardware, and they spend a lot of energy. Once they've solved this maths problem, they tell the rest of the miners, I've solved this maths problem, now I'm going to put transactions through the network. And if they're dishonest about any of the transactions, the remaining miners then don't accept those transactions. And so the miner then has lost that investment in energy and the capital investment. They still have the hardware, but they need to use it again now to mine a new block. If they're honest, they get a reward, and that reward is called the block reward. And so a few of the crypto tokens or Bitcoin are printed and awarded to the miner.
So that's done with graphics cards to do the mathematical problems. Is that why the graphics cards went up in price and why there's these farms with just, machines built with lots and lots of graphics card?
Exactly right. So graphics cards are a piece of computer hardware that are usually used to make graphics, so video games or pieces of art or animation. And what the miners found is that these pieces of hardware were also the best at solving these maths problems. And so they started buying up these graphics cards, increasing the price and making a lot of video gamers and artists very upset. And so as they became more and more professional and commercial, as the price of Bitcoin increased in value, they started really bidding up the prices of these graphics cards and setting up huge warehouses full of these graphics cards, mining away, trying to solve these maths problems in order to win the right to the next block and put in transactions into that block and hence get rewarded.
There's a few ways of validating these blockchain transactions. There's proof of work and proof of stake. What's the difference between these two methods?
So proof of work was the original way of validating transactions on a blockchain, and Bitcoin uses that. And proof of stake is another way. And there are a few blockchains out there that already use that. There's a huge debate going on in the crypto community about which method is better. And part of the reason for the huge debate is that there isn't a lot of evidence yet. Maybe when blockchain technology is 50 years old, it'll be settled, one is better than the other. But right now on paper, they both have different strengths. So how proof of stake works, so what we described about mining, that's proof of work. And proof of stake is an alternative method. And rather than having someone invest a lot in hardware and then a lot of energy, and that's what they stand to lose if they put through fraudulent transactions, instead, proof of stake requires validators to put up some capital. And as long as they're honest in how they validate transactions, they get a reward. If, on the other hand, they put fraudulent transactions through, then the capital they put up is slashed. They lose some of that capital. And then that acts as the incentive for the validator to stay honest, as opposed to the work that they invested when it comes to proof of work. Now, the main advantage of proof of stake is that it's more climate friendly. It uses something like 99% less electricity. And so quite aside from what's a better mechanism for validating transactions, it is definitely more climate friendly.
So the Ethereum blockchain, I think they call it the Ethereum merge, is switching from proof of work to proof of stake in the next few months. What is this going to do to the Ethereum blockchain?
While there's been other blockchains out there that are using proof of stake, the Ethereum chain is the second biggest change in terms of value. There's a lot of transactions that are happening on there, and it's going to swap over from using the method that Bitcoin currently uses, proof of work, to proof of stake. And it's going to swap over without going down. So without turning it off for a few hours while they change it. And the main reason driving this is to be more environmentally friendly. People that believe in proof of stake will list a bunch of other benefits to it, which over time may or may not be borne out. And so if this happens, the main benefit will be that the energy used by the Ethereum network will drop by 99%. The Ethereum network has also been notoriously expensive to use. And as people use the Ethereum network more, the price goes up. Now, a common misconception is that swapping over to proof of stake will lower the cost of using the network. And this isn't the case. It's merely going to make it more environmentally friendly by using less energy. However, because the people validating the network will go from mining to validating and hence have much less cost, they won't be spending all this money on energy and on hardware. Because of that, the reward for validating transactions needs to be much lower. It's still very profitable to be a validator, even if the reward is much lower. And in the case of many of the blockchain networks, this reward is basically created out of thin air. Famously, Bitcoin's issuance continues on until it reaches 21 million, at which point it'll stop. In the case of Ethereum, there is no maximum. However, currently, 13,000 Ether are issued every single day. After Ethereum moves over to proof of stake, the reward in any individual block is going to drop to 1,600 per day. So this will reduce Ethereum issuance by about 90%, which may then also have some effects on the price because there'll be less Ether coming onto the market every single day. So if you reduce supply and demand stay the same, this could increase the price. And in recent days, we've seen the price of Ether going up quite aggressively. And the main reason for this is that the merge or the swap over from proof of work to proof of stake has been talked about for many years. And the developers behind Ethereum and working on it, they have put off the merge many, many times. And that's because there's so much value at stake that they won't work to any timeline. They'll only do it when it's ready. In recent weeks, they've completed a few test merges, which have gone successfully. And now there's one more test merge on the horizon. And if that goes successfully, it'll be time for the real thing. And so a date was put into the ground about a week ago. A flag was put on the ground for a date being the 19th of September. And so that's increased confidence the merge will happen. And hence, we've seen that probably driving up the price of Ether compared to the rest of the cryptocurrencies.
So you've mentioned now that the drop in power consumption with this change will be over 99%. How much of an issue has power consumption been in mining of Ethereum?
Just recently, this week, some senators in the US wrote a letter to both the Department of Energy and the authority responsible for the environment, I think it's the EPA, requesting that Bitcoin miners need to declare their energy use. And so this has been a topic of concern. We know that emissions is a problem in the world, that it's leading to climate change. And so many people are worried about the use of energy of these networks. And there's many arguments that people who believe in blockchain make about this, such as the fact that a good chunk of the energy actually comes from renewable sources. And it's a good way to use energy, a lot of people say. So it has been quite a contentious issue. Furthermore, there are many investors that have environmental goals, out of, as it's called, ESG, environmental, social, and governance goals. And this precludes them from investing into cryptocurrencies. Again, there are arguments about why Bitcoin and other proof of work chains actually are ESG positive, but it's still a matter that's up for debate because of its high energy use. And so if Ethereum manages to convert to proof of stake successfully, well, then this will provide an answer to many of those objections. And so potentially there are investors standing on the sideline who are waiting for, potentially amongst other issues, also for Ethereum to become more climate friendly. And so it may just remove some objections along the environmental lines for investors.
And will the lower barrier for entry in terms of owning actual physical hardware, will it encourage more people to become validators?
Yes, that's right. So this is one of the arguments that people that strongly believe in proof of stake make, that in order to mine blocks in a blockchain, you need specialized hardware, you need to buy it at scale, et cetera, et cetera. And it's actually the threshold to do it economically has gotten quite high. And one of the promises of Bitcoin was that anyone could actually mine and validate the network. However, with the move to proof of stake, it now becomes viable to run a validator on a laptop. However, there are probably still some other economies of scale, but many service providers have popped up where you can just deposit Ether with them. It's called staking it. And then they will actually run it for you and provide you the relevant rewards. But however, the option is much more within reach for someone to run a validating node on user-grade hardware, a laptop.
And then in another avenue of the cryptocurrency world, there's been skepticism caused by the crash of Celsius and Voyager, where investors' assets were frozen and then the companies went into bankruptcy, so people couldn't get their money out. What happened there, and how has properly decentralized finance fared any better?
That's a great question. With the failure of Voyager and Celsius and some other of these crypto banks, I'll call them, numerous people have been asking, has this been a failure of blockchain and cryptocurrency in general? So the reason that I call these crypto banks are that they were accepting deposits from the public, not necessarily in the form of cash, but in the form of tokens, and promising to pay an interest rate on those tokens. And how are they generating the money to pay this interest or the tokens? And typically, the promise was that they were lending this out to other parties, hedge funds, etc., who were using this in their running. Some of these entities, like Celsius, were also investing it in DeFi, decentralized finance, which are just programs, lines of code that run on the blockchain, no humans involved, to generate these yields and to pay their clients. What turned out to be the case is that most of these crypto banks were lending to a very small number of parties. In fact, it seemed like most were lending to a hedge fund named Three Arrows Capital. And they weren't speaking to each other, and so they didn't realize that the same collateral for these loans was used in multiple places. And also the sheer amount of leverage or debt that Three Arrows Capital had taken. Three Arrows Capital is a bit of a celebrity in the world of crypto. And so it seems like they also didn't employ good risk management, that they were just impressed by Three Arrows Capital's celebrity status. instead of actually looking at their financials and managing risk. And now some of these entities have filed for bankruptcy, Voyager and Celsius, while others were rescued. Another big crypto player, the founder of FTX, Sam Bankman-Fried, has bailed out at least one of these. And there may be other bailouts going on behind the scenes. However, what's interesting is to look at Celsius. They had made loans to a bunch of hedge funds, including Three Arrows Capital, but they'd also made loans, taken loans from these DeFi protocols. They posted collateral and borrowed money, borrowed tokens. And interestingly, Celsius repaid all of their DeFi loans before filing for bankruptcy. And the reason being that when it comes to DeFi, there are just rules in code. There's no opportunity to be impressed by someone's celebrity status. There's no opportunity for exceptions. And most of these DeFi protocols, they're also over-collateralized. If you deposit collateral of $1 million, you can only take out loans of $500,000 to $600,000, depending on what the collateral is. And so if Celsius did not repay these loans, the collateral would have been sold and taken away from them, including a penalty for being liquidated. So DeFi actually emerged out of this just fine. And what we see is that, in fact, the failures here were the failures of centralized institutions. So even though there's a misconception that crypto or blockchain failed, in fact, it's evidence for how well blockchain fared. DeFi fared perfectly well. All the depositors into these protocols did not have to take any haircuts. The protocols didn't experience any losses. And the centralized institutions, they made bad decisions, and they are the ones that are now in loss positions and having to take haircuts.
Brilliant. Well, thank you so much for taking the time, Gaurav.
Thank you, Ross.